Welcome to today's Explainer. I'm putting on my equity research analyst hat today to look at a true global titan, Unilever. We're going to break down their 2025 transformation, specifically looking through the lens of value creation, competitive moats, which the Warren Buffett fans will love, and strict financial prudence. Let's just jump right in.
$3.4 billion. Let that number sink in for a second. That is how many people globally use a Unilever product every single day. We're talking about nearly half the human population reaching for a Dove soap or a Knorr stock cube on a daily basis. When we talk about finding a business with a deeply entrenched economic moat, that staggering volume is literally the bedrock of their advantage.
So here is our roadmap for the analysis today. First, the global FMCG giant. Then, AI and supply chain. Third, winning in digital commerce. Fourth, the competitive moat. And finally, we'll crunch the numbers on their 2025 financial performance.
All right, part one, the global FMCG giant.
When evaluating management quality, you want absolute clarity. And Unilever's value creation ambition is crystal clear. Drive absolute profit growth and top-tier shareholder returns. They're executing this by pulling two main levers, volume growth and gross margin expansion. The catalyst here, a major pivot toward high-growth, what they call SASSY brands. Brands driven by science, aesthetics, and cultural relevance. They're basically shifting the portfolio away from just sheer size toward high-margin cultural resonance.
Now, you might know that Unilever operates in over 190 countries and owns more than 400 different brands. But, and this is absolutely crucial for capital allocation, their true strategy is all about concentration. Out of those 400, management has designated just 30 power brands. Why? Because those 30 alone drive nearly 80% of total turnover. Management is ruthlessly focusing their capital into these high-margin category leaders. From an investment standpoint, that kind of focused simplicity is a classic indicator of a truly great business.
Moving on to Section 2, AI and supply chain.
Take a look at this quote from their Chief Product Supply Chain Officer, Vicky Cuthbert. She says, demand cycles for consumer brands have shortened from months to hours. Months to hours. That highlights just how insanely volatile modern retail is right now. If your supply chain can't adapt in hours, you're going to lose the sale to someone who can. This kind of volatility tests operational resilience to the absolute limit.
For example, consider the logistics stress test of the 2026 FIFA World Cup. Unilever activated 35 brands and 180 limited edition products across more than 120 countries. And they didn't just pre-ship boxes and hope for the best. They reacted to real-time demand, literally dispatching world champions limited edition deodorants to Spain right after the final whistle blew. That is unparalleled real-time supply chain agility.
And how do they do it? It's powered by a highly advanced AI ecosystem that actively protects the bottom line. Their forecast engine evaluates 5 million different product customer combinations every single week, generating predictions 104 weeks out. Plus, on the factory floor in Hafai, AI boosted equipment effectiveness by 8%. Over in the US, digital twins simulated manufacturing to cut physical waste by 20%. This isn't just flashy tech, it's driving structural cost reductions and expanding margins.
Let's dive into Section 3, winning in digital commerce. To actually get these efficiently made goods to consumers, Unilever's B2C digital commerce is built on 3 pillars. First, major retailers like Walmart and Amazon, fueled by heavy retail media investment. Second, social commerce, think TikTok and Douyin, to capture immediate impulse buying. And third, quick commerce for ultra-fast delivery, which is exploding and capturing massive market share in places like India.
To put some hard numbers on that converting power, check this out. During a TikTok live event in the UK, Vaseline's Gluta-Hya bundles completely sold out in just 6 hours. It was actually one of the top 20 streams globally that day. That perfectly demonstrates how a legacy company is successfully adapting and monetizing the modern social content pipeline.
All right, Section 4, the competitive moat.
So, any value investor looks for a durable competitive advantage. Pure-play rivals, like L'Oreal and beauty or Nestlé and food, are incredibly specialized. But Unilever's moat? It's built on structural breadth, because they operate at a massive scale across 5 major categories, from ice cream all the way to home care. They unlock cross-brand efficiencies and get leverage with retailers that specialized competitors literally cannot match.
But honestly, their deepest, most unassailable moat is in emerging markets. We're talking about a decades-long, deeply entrenched presence across India, Africa, and Latin America. This isn't just surface-level export revenue. These are local supplier relationships and unmatched physical distribution networks reaching millions of tiny mom-and-pop stores. Add in their purpose-led heritage, like the Lifebuoy campaigns, and you have a localized barrier to entry that would take a rival billions of dollars and decades of work to replicate.
Finally, Section 5, 2025 Financial Performance. Let's look at the numbers.
Okay, looking at the last 3 years, total turnover in 2025 dropped to 50.5 billion euros. Now, a strict value investor might see a top-line drop as a red flag at first glance, but you have to look at the underlying operating margin. Even though turnover dipped, margins expanded sequentially. They went from 17.6% in 2023 up to a highly robust 20.0% in 2025. This proves management is laser-focused on the quality of revenue over vanity metrics. That is fantastic operating leverage.
And about that top-line drop, it wasn't a demand issue at all. Unilever faced a massive 5.9% adverse currency headwind. Key emerging market currencies just depreciated heavily against the euro. So, operationally, the business actually grew. The foreign exchange translation simply masked it on the headline reported numbers.
If we strip away that FX noise, which is exactly what a rigorous analysis requires, we see the true health of the core business. In 2025, underlying sales growth hit 3.5%, and crucially, that was driven by 1.5% underlying volume growth. That means they aren't just relying on pricing power to artificially inflate sales. They're driving genuine increased physical demand for the products themselves.
And when we segment that growth, beauty and well-being emerges as the primary engine. It delivered a stellar 4.7% underlying sales growth, compared to a solid 2.6% in personal care. This directly validates management's capital allocation strategy. They pivoted toward those premium, high-margin SaaS brands we talked about earlier, and it's paying off.
Ultimately, the balance sheet passes every stringent test for financial prudence. In 2025, they generated 5.9 billion euros in free cash flow, boasting a pristine 100% cash conversion rate. Leverage is highly conservative. Net debt to underlying EBITDA is strictly capped at 2.0x. And they are internally funding their own growth, pouring 836 million euros directly into research and development, zero reliance on dilutive equity. It's a remarkably healthy setup.
So Unilever has clearly proven they possess the durable moat, the expanding margins, and the conservative balance sheet needed to weather intense global volatility. But as retail continues to shift from quarterly cycles to literal hourly trends, the ultimate question we have to ask is, can a legacy giant stay agile enough to rule the next century of commerce? Based on their 2025 execution, I'd say they are building the exact engine needed to do just that. Thanks for joining me for this explainer, and I'll catch you in the next one.